Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
Imagine waking up one day and discovering that everything you believed about wealth, ownership, and economic power was backwards. That the richest nations on earth aren't rich because of what they own, but because of what they owe. That the stability of your country, the value of your currency, the future of your children, and even your personal freedom depend not on money, but on the expansion of something far stranger, far more engineered, and far more dangerous: debt. And here's the real twist. Debt isn't just tolerated. It isn't just allowed. It's the most valuable asset in the entire global financial system. Why? How? And who benefits from a world where the only way to keep the economy alive is for everyone: governments, corporations, families. Even you two owe more tomorrow than they did yesterday. This is not a conspiracy. It's not even a secret. It's simply a system that became so normal that no one questions it anymore. A system so deeply woven into modern life that most people can't even imagine another way. But it wasn't always like this. It began slowly, with a loophole nobody noticed, a habit nobody questioned, and a decision nobody reversed. And today, that system has grown into a global machine so vast and so fragile that a single disruption could rewrite the fate of entire nations. So let's pull the curtain back, because once you understand the origins, the rise, the breaking points, the failed fixes, and the eerie patterns repeating today, you'll never look at money, banks, or government policies the same way again. And by the end of this story, you'll see exactly why the world quietly depends on debt to survive, and why that dependency is the greatest risk of our century. Let's go back to where it all started. It begins in a time when money actually meant something, when dollars, pounds, rupees, and every major currency weren't just numbers typed into a balance sheet, but promises backed by something real, something scarce, something governments couldn't print at will: gold. For most of human history, wealth had physical limits. You couldn't expand the economy unless you found more gold. You couldn't create money unless you possessed the metal itself. The system was slow, rigid, predictable, and difficult to manipulate. But governments hated it. Banks hated it even more. A currency backed by hard metal meant they couldn't spend beyond their means. They couldn't wage long wars. They couldn't fund massive projects instantly. They couldn't bail out industries or pump their economy with injections of new money. Every decision had to respect reality. But crisis has a strange way of opening doors. The first major crack appeared in 1914, when World War I erupted, as nations rushed to finance the bloodiest conflict in history. They suspended the gold standard. They needed money, lots of it, and printing it was easier than digging it. For the first time, money creation outpaced real value. And once governments tasted that power, the world would never go back. After the war, countries promised they would return to sound money. Some did, briefly, but the damage was done. The system had already shifted from a world of limited money to a world of flexible money, and eventually to unlimited money. Banks realized something important during this transition. Debt could be created from nothing, as long as people trusted the system. A bank didn't need to have the money it loaned out. It only needed enough depositors to believe their money was safe. Fractional reserve banking, an idea once considered absurd, became the foundation of the modern economy. For every $1 deposited, banks could create multiple dollars of loans, and those loans became assets. Tradable, transferable, profitable. Debt wasn't a burden anymore. Debt became a product. Debt became business. But this was only the beginning. Fast forward to 1944. The world, exhausted by war once again, gathered in a quiet town in New Hampshire to design a new global financial architecture. Bretton Woods. The United States emerged as the new financial superpower. Nations agreed to peg their currency to the US dollar, and the dollar itself would be pegged to gold. In theory, it was stability. In practice, it was the start of something far more interesting. Because the US had a unique advantage, the world needed dollars to trade, and the US could print dollars. It was only a matter of time before temptation overwhelmed discipline. By the 1960s, America was printing far more dollars than it had gold to back. Countries like France noticed the imbalance and demanded gold in exchange for their dollars, and suddenly, the illusion cracked. On August 15th, 1971, President Richard Nixon made a decision that changed the world forever. He announced that the US would no longer convert dollars to gold. The gold standard died that day, and the age of pure debt-based money was born. From that moment forward, money had no intrinsic value. It wasn't backed by metal, commodities, or even national productivity. It was backed by one thing only: debt. Because in a fiat system, every new dollar must be created as debt. If you have $100 in your wallet, somewhere in the system, someone owes $100 plus interest. If that debt is repaid without new loans being issued, the money supply shrinks and the economy contracts. In this new system, for the economy to grow, debt must grow. It's a pyramid with no top, a treadmill with no off button, and governments, businesses, and citizens were all encouraged to run faster. But to understand why debt became the system's most valuable asset, you have to see what happened next. Banks discovered that loans weren't just profitable, they were transformative. A bank could issue a mortgage, collect payments for decades, and then sell the mortgage as an asset. That asset could be bundled, sliced, repackaged, sold again, insured, leveraged, and used as collateral to create even more loans. Debt transformed from an obligation to a commodity, from a promise to a product, from a risk to collateral. And as demand for debt-based assets grew, banks had every incentive to create more loans, approve more mortgages, issue more credit cards, and push more borrowing. Governments loved it because more debt meant more economic growth. Corporations loved it because more credit meant larger expansion. Consumers loved it because they could buy homes, cars, and lifestyles far beyond their actual income. But here's the hidden danger. When debt becomes the foundation of wealth, the system requires constant expansion. If borrowing slows, the economy slows. If borrowing stops, the economy collapses. This creates an addiction far stronger than any chemical dependency. And like all addictions, it masks a growing fragility. The first major warning sign came in 2008. You already know the headlines: Lehman Brothers, subprime mortgages, global meltdown. But what most people don't understand is the root cause. The crisis wasn't just about bad mortgages. It was about the fact that debt had become the world's primary asset. Banks weren't investing in factories, innovation, or long-term growth. They were buying and selling bundles of debt. When those debts turned toxic, the entire financial industry froze. Governments were forced to step in not because they wanted to, but because the financial system had reached a point where if debt failed, everything failed. The world learned a terrifying truth. Banks could not be allowed to collapse, because the collapse of debt meant the collapse of money itself. The solution, ironically, was more debt. Central banks printed trillions. Governments borrowed trillions. Interest rates were slashed to zero. And instead of reforming the system, the world doubled down on it. Debt soared to levels never seen in human history. By 2020, global debt had crossed $300 trillion, more than 3 times the size of the global economy. And yet, the system demanded even more. In a world built on debt, stability requires expansion. Stagnation is dangerous. Contraction is fatal. That brings us to today, where something deeply troubling is happening. Debt is becoming too valuable. Governments rely on it for budgets. Corporations rely on it for share buybacks. Real estate markets rely on it to keep prices inflated. Consumers rely on it to maintain basic living standards. And central banks rely on it to keep the financial system from collapsing. Debt is not just an asset. Debt is the keystone holding the entire arch together. Remove it, and everything falls. But cracks are forming. Interest rates, after years near zero, have risen sharply. Nations are struggling to pay their debts. Consumers are drowning in credit card balances. Corporations are refinancing at higher rates. And banks are quietly absorbing losses behind closed doors. Meanwhile, some of the largest economies in the world, Japan, Italy, the United States, are hitting debt levels once considered impossible to sustain. And the pattern repeating today is eerily similar to the patterns before every major financial crisis: rising debt, rising rates, slowing growth, increasing fragility. But here's the twist. The system can't fix itself without breaking itself. If governments try to reduce debt, the economy contracts. If central banks raise interest rates too high, borrowers default. If they lower rates too much, inflation explodes. If they print money, currencies weaken. If they stop printing money, markets crash. It's a trap with no exit. So the world continues forward, balancing on a thin line between inflation and collapse, boom and bust, all while pretending everything is fine. But the truth is simple. We live in a world where debt is more valuable than money, where IOUs are treated as wealth, where the system can survive only as long as it keeps expanding. And the most dangerous part? Most people are completely unaware of it. They think recessions happen randomly. They think prices rise naturally. They think governments control the economy. But the economy controls the government. And the debt controls the economy. So what happens next? Nobody knows. But the patterns point toward one of 3 outcomes. a controlled reset, an uncontrolled collapse, or a new system emerging from the ashes. Before we end, here are 3 takeaways you cannot ignore. First, debt is not just a financial tool, it is the core of the global system. If you understand how debt flows, you understand how money flows, how power flows, and how economic cycles unfold. Second, the system depends on expansion. Every financial crisis in modern history from 1929 to 2008 was triggered not by too much debt, but by debt growth slowing down. Pay attention not to the debt level, but to the debt velocity. Third, you cannot rely on governments or central banks to protect you. Their priority is not your wealth. It is the survival of the financial structure. Their decisions will always favor the system over the individual. And here's your warning. The next decade will determine whether the debt-based global economy evolves or implodes. The signs are already here. Rising rates, struggling governments, fragile banks, shrinking real incomes. This is not fear. This is mathematics. If you want to understand where the world is heading, follow the debt, because the system is built on it, and one day, something will break. If you found this eye-opening, and you want to see more deep dives into financial systems, hidden economic structures, and the stories behind the world's biggest secrets, make sure you subscribe, like, and share this video with someone who needs to understand the truth about our global economy. And ask yourself, is debt really wealth? Or is it the world's most dangerous illusion? The next video might just answer that.